That's where it is. Okay.
Hello, VedaVA community. This is Helmer with your mortgage market update for the week. It's January 17th, 2024. This week, I am joined with the lovely Brandi Brickler. Brandi, thanks for joining us. If you don't mind, tell everybody a little bit about yourself.
Yes. So I am a mortgage broker with that I volunteer with VedaVA. And I am located in Texas, specifically Austin, but I help people all over Texas. And I've been doing this for over 10 years. So
10 years. That makes me feel old because I've been in the industry 23. 10's a long time.
I'm just a baby.
I remember when I joined, I wasn't even 23. Oh my goodness. Anyway, all right. So tell you what, everybody, thank you for joining us. Remember, if you have any questions or comments, go ahead and post them. If you're here live, give us a hello, say hi, let us know your name. The software doesn't always show me your name, so let me know who you are and if you're looking at buying a home or refinancing or why you're watching today. And if you're watching on the replay, we love that as well. Don't forget to go ahead and give us a hashtag replay in the comments. Let us know that you were here. You can ask any questions that we had. So with all that said, I'm going to jump over to the slides and let's see, pop that up here. We'll start off with the rate recap. So remember, this is not an offer to lend. And when we talk about rates, we're talking about averages and generalities. Your unique situation is going to depend on your unique situation. So make sure you shop around and shop your rate. And you can always find a great mortgage pro who has already been vetted for you by going to vettedva.com. You can also find real estate agents that have been vetted for you. Go to vettedva.com and check out the map and you'll find somebody local. So that said, a lot of people say, hey, Helmer, what are rates like? This is what I'm getting offered. Does this sound right? So if you're finding rates that are in the high fives to the mid sixes for a VA mortgage, that's pretty much in that realm. A lot of them are going to be in the sixes. Brandi, as far as, I don't know if you've seen, we've seen rates creep up, a bit yesterday and some more today. Where have you been generally finding, VA rates in your market?
Right at the high fives, mid sixes. So that's pretty average. So depending on credit score, of course.
Okay. And then conventional rates, if you're not going with a veteran mortgage for some reason with a VA mortgage, you can find conventional rates. They're going to be higher. They're generally in the mid sixes to the mid sevens. I would say right now, you're doing well if you get below 7, depending on credit score and amount of money you're putting down. If you're getting something in those mid sixes, definitely look closely, see if you're paying any fees and points. Most averages are going to be in the 6 3/4 to 7% range is what I'm finding. What about you, Brandi? Do you think that sounds about right?
That's exactly where I'm at from when I'm pricing out any conventional deals.
Okay, good. So that's, if you are out there pricing up your mortgage, that's what you should find. Now, as far as where rate's going to go, I've left this line up here for weeks, and it's a beautiful line. The worst rates should be behind us. October of 23 is when we saw what has been the worst rates in a couple of decades, and a lot of things have changed since then. However, we've seen rates that were really good at the end of the year, kind of creeping a little bit at the beginning of this year, and now they're starting to move up. And rates look like they are likely to start creeping a bit higher as markets begin to let go of the idea that the Fed is going to cut rates at their March meeting. And I'll talk more about that. But right now, mortgage rates are very, very heavily influenced by what markets think the Fed is going to do. So that's important. Basically, markets believe that the Fed is done raising rates. And we've seen rates have been raised since March of 2022. The Fed funds rate is the rate that they raise their policy rate. It's up at 5 1/4. And the expectation is that it will stay there for a little while longer, and then the Fed will start to cut that Fed funds rate. And the reason that they raise the rate and that they're going to cut the rate is generally to control the ebb and flow of the economy and the labor market. The Fed has been fighting inflation. The way that they go about fighting inflation is to slow down the economy. That reduces demand. People have less money to be spending, and therefore demand goes down. Prices will go down when demand goes down. So the Fed has risen rates since March of 2022, and the problem is that when they raise those rates, eventually it's going to slow down the economy too much, and that would drive us into a recession. Now, a year ago, we were talking about how we would end up in a recession. and rates would probably start to come down. And that never happened. Brandi, do you remember when everybody was talking about, that we should see rates come, the recession was going to happen? Some gurus in our industry were telling us to circle May 10th as a date. It was all going to come together.
Yes, and then it didn't happen.
Yeah. And that's the problem with with forecasting. So, and we have seen lots of signs of the economy doing well, the labor market doing well, which is great for most people, but it's not great for rates, for mortgage rates, for credit card rates, car loan rates. All of those rates are higher. Now, the good news is your rates on savings accounts and CDs, those have also gone up, but generally, when you're borrowing money, you'd like to see rates lower, wouldn't you? So now, if the economy does show signs of slowing, and if the labor market softens, meaning that we see less job openings, more people losing jobs, and unemployment rising, it's not what we want to see. But if we do start to see that happen, that will help rates to improve a little bit further. However, if markets continue to accept this idea that the Fed won't have to aggressively cut this year, and that they're going to be able to maybe take small increments and maybe not even start cutting rates until their May meeting or their June meeting, well, we're going to see mortgage rates kind of stagnate, creep up a little, fall back a little, but really not go anywhere, and definitely not get significantly improvement. And when I say significantly or significantly better, when I say significantly, generally what I mean is, a quarter point to a half a point at that point. And I don't think we're going to see that. Now, politics will soon start to play more of a role. We're, of course, in an election year. That all that stuff is just starting to hit the headlines, but it's not really having an effect yet. There's nothing that you have to worry about there. As far as the forecast goes, over the next 15 days, rates should likely hold steady, but they could move a little bit higher. We're starting to see the signs that they're moving a little bit higher. The next few weeks, rates are not likely to move much lower from here unless we get a very favorable message from the Fed at their Fed meeting at the end of January. And Fed Chair Jerome Powell will have a press conference. And if we see, if they give this the impression that they could be more open to cutting rates, then markets will like that. But the data that we've seen recently not pointing to that. Even today's retail sales data showing how consumers are out spending came in the strongest in the last 3 months. And that's not signs of a weak economy, which means there's no reason to see rates go down. And as far as 2024 goes, rates should move lower as we continue through the year, but they're not going to be anywhere near the pandemic low. So with that piece of the conversation, Brandi, let me pull you back in. And if rates are not likely to move much lower, why would somebody want to buy a home now? Why wouldn't they want to wait until rates do go down?
Well, we have seen this year, like even with rates creeping a little bit lower since, the very first of the year, we have seen some increased demand. And so in some markets, we're actually seeing competitive offers again back on the table. And that's exactly what we don't want. We don't want you paying more for a house just because you're trying to save on interest rates. So we want to make sure that you can capitalize on what's available out there in the market as seller concessions right now in some places. And you can get a rate that is not likely to go too much lower throughout the end of the year. So you're pretty safe.
Now, let's talk about seller concessions and kind of home demand. So generally, there's a pattern. When rates go up, then that demand drops. So more homes become available on the market. Sellers have to be more aggressive trying to sell their home. That generally equates to price drops or seller concessions, meaning the seller agrees to pay some of the borrower's costs in the transaction. We didn't see as much of that this year, though. Why is that?
This year specifically, as far as like seller concessions go, people who were selling, who bought like 3-4 years ago, they had a ton of equity in their home. And so they had the option. So they had like fairy equity, like the market appreciated so much that they had a lot to give. And so as the market tightens a little bit, there's less of that to be able to offer like a new buyer. So we're starting to see that tighten.
Yeah. And the other thing that I definitely noticed is that we didn't have as many people trying to sell homes because they had what we call a golden handcuff. They were in a home, even if they didn't love that home, but they were in a home with interest rates that might have been in the 2s or the 3s, and they just couldn't couldn't make that move to sell that and buy something 7-8%. Now, as we see mortgage rates start to creep down a little bit, even into the fives, those people are getting antsy. Right. If I live in a house and maybe the kids are sharing a bedroom and they're fighting all the time, and it's just, there's other reasons now that I want to move. And if I can afford it, it becomes easier to say, you know what, we can put that extra few $100s into the house. It's going to be okay. And they start to come to terms and they start to decide, okay, maybe now is a good time to sell. But what happens is that also puts more buyers into the market. So right now we're at an inventory shortage. There's just not enough homes out there. And that's what's keeping home prices high. If there's not enough and there's more demand, well, nobody has to lower their prices to sell. And people that, I see on YouTube and different social media, and they're like, oh, there's going to be more inventory coming to the market and things will get better. And what they don't realize is that a lot of that inventory is going to be more buyers. They're selling one, buying another. So it isn't going to bring all that inventory per se. And as more people are able to get back in the market and rates do drop down, well, then we have even more demand, which means home prices go higher, not lower. So that's a lot of what we're seeing. And you're in which market? You're in Texas?
I'm in Texas, yeah.
And what is the Texas market like right now?
So so it just depends on different pockets. Like obviously there's some more popular areas and people are having to move a little bit further outside of like cities and things like that. So it just depends on what people are looking for, because there's a different buyer. There's some who are looking to live in the city and then some who are looking to live nowhere near the city. So in the cities, it's a little bit more competitive. There is a lot of new construction in all the bigger cities. So that's always a big player. But, we are starting to see some resale homes come back to the market, especially maybe even some rentals, which were previously rentals coming back to the market.
Okay. Now, here's a comment. I saw the slide that said rates will drop at nowhere near pandemic lows, but I purchased my second house in 2012 and had a 2.3% interest rate. Well, I got to tell you, that was one shiny penny, because I don't remember rates being in 2012 anywhere near 2.3%. And if you got that, I don't know the circumstances, certainly not calling you a liar, but I would say that those were far and few between. Now, when I bought my house here in North Carolina in 2017, I was at 4 1/8. And I paid $800 to get that rate. And that's more along the lines of, I think, where rates will go in 2024 and 2025. I think that we will spend a lot of time getting into the fives and then possibly look at maybe seeing the fours. But again, I don't know where you got 2.3%. Brandi, what is anything that you remember? You said you've been here 10 years, so that puts you...
Yeah, 2014 was when I came in the business. But I mean, anything like you're talking about is when things were right around fours. I never even saw anything lower than, I think, a 4 when I started. So it also depends on, what you paid for points, like what was your down payment, things like that. So even with points, I don't remember. And again, I've been in the business about 24 years. I actively originated and wrote loans till 2010. I was an executive in 2012. So I wasn't day to day on the rate sheets, but I also was tied into a company called Rate Alert. And so I'm pretty familiar. And again, go ahead. There was also some adjustable rates floating around at that time as well. So maybe we're talking, while we're talking fixed rates, this might be an adjustable rate mortgage that we're discussing.
That's a good point too. And it is possible. And adjustable rates were more competitive back then. This time around, when fixed rates went up, adjustables kind of went with them. You couldn't really get great deals with adjustable rates this time. But that said, whatever you got in 2012 at 2.3, I'd give you a hat tip to that. But as far as where we're going, I'm going to stand tall and stand pat on what I said. I think that if we see rates that fall into the fives, it's going to be where we spend most of 2024. And if we can get into the fours, again, paying points maybe, or even without necessarily paying points, that would be closer to the end of the year and after the Fed has started to reduce rates. Or if we do see signs of a recession, if we see the economy turn around, if we see unemployment increase, or if we get drawn into a war, or if there's more concern about what's going on in the Middle East, which is ramping up, or politics could play a role in all that. So that's why I give you what the crystal ball says, but I promise you, I'm certainly not going to bet my house on it. So. as far as that goes. But what else would you say to somebody that was, out there house hunting right now, if they're starting to get back in the market as rates start to fall down? What kind of advice are you giving?
Yeah, so one of the things I hear a lot of, the words free refinance are always sort of floating out there when people are purchasing, and if they have a lower credit score, maybe their interest rate's higher. So we're hearing that free refinance, and I definitely like to tell people who are shopping, a refinance is not free. Especially for VA loans where, your lender can roll up to 2 points into that loan. And so it's increasing your loan balance, and that's not exactly advantageous. So you should be working with somebody who's deciding whether or not like buying down the points is actually good recoupment for how long you're going to be in the house, or if an actual refinance is probably the best option. But it's still, get out there. There's a lot of good deals out there.
Right. Now, as rates have come down, people that bought a house in October, say when rates were at their highest, they may be thinking about refinancing now. And one thing that I would note is, because what Brandi said, piggybacking on that, although you may not have out-of-pocket expenses, meaning I don't have to stroke a check today, there are costs that are going to be associated, or if the lender is giving you a higher credit to cover those costs, that means that you're getting a higher rate. That money's got to come in there somewhere. And if you are looking at refinancing now, definitely talk with a mortgage professional and see if maybe, and again, it's going to be different for different people. If you're in a VA mortgage, if you're doing an IRRRL, you've got to wait at least 210 days anyway. Correct. But for somebody that's not in a VA mortgage, you want to kind of time this at a good time. And it may be a little early right now. I would wait, because we're likely to see rates that are going to move a little bit lower through 2024 as we get through this first quarter, rather than see them move higher. And if you jump on the first good rate, you might kick yourself in 2 months, because you're not going to refinance again. And you'll say, man, if I had just waited, it would have done this. What do you think about that?
That has been 100% my advice. So I've run through the numbers with a couple of clients who locked within the last year or so. And my advice to them was, let's just wait and kind of see, because the risk reward for like being able to have a better opportunity 3-6 months down the line is probably better for them.
And by the way, all I have is Facebook user, so I can't use your name. Unfortunately, if you put your name in, I'll be glad to have it. But we appreciate your comments and appreciate you coming in. So it said, I just looked up 2012 annual rate was 3.66. And I wanted to share that with you all as far as when that comes up. That's a great point. So like, for example, long-term mortgage rates began 2010 and then fell to blah, blah, blah. As the Fed announced that it would no longer be buying bonds, that was what we called the taper tantrum, right? Fell to around 3.35. So as we look at rate charts, generally rate charts are going to show what we call the Freddie Mac rates. And let's see, historical rate chart. So these are Freddie Mac, and this is a survey that's done once a week among lenders, and it doesn't necessarily show the points that they're charging or the fees in there. So when we look at, say, 2012, and that was right around here where this low point. I'm looking to see if we have a better one, but that may have had points. So for sure. And like I said, even with points though, getting to 2.3, that was a great loan. So yeah, again, I still don't think that we'll see this time around that we're going to see rates come down anywhere near that low. We need to see the economy slow down. There was a reason back in 2012 why bonds were at that level, why mortgage rates were at that level. There were a lot of economic factors, and we just don't have those same factors. And as far as sending information, if you want to share your information with Brandi, and if you need help on getting a mortgage today, again, check out vetava.com. You can certainly reach out to Brandi. The one thing about the VetaVA community, there is no sales pressure, and I don't want to apply that. So, you could check out anybody, but I will vouch for Brandi as a friend that she is awesome at what she does. And if you have any questions, she can answer them for you. But you can post all those questions in the VetaVA community, and any of the moderators will answer those for you or help you as well. So, but all of that said, as far as where we're going from here, again, it's more likely that we see rates move lower over time than higher. That's a good thing. But over the next couple of months, it's going to be a lot of depending on what markets are pricing in on when the Fed will go ahead and cut rates. And if you'd like to get some insight into that, you can Google CME Fed Watch. Okay, CME FedWatch tool is a free tool, and it's this chart here. And what that shows us, these tabs across the top are the dates of the next Fed meetings in 2024. And it shows us what are Fed futures trading at. In other words, what are the markets think is going to happen? Let me get rid of this banner real quick. What do the markets think are going to happen? So, for example, the next Fed meeting concludes on January 31st. It starts on the 30th. It's a 2-day meeting. It concludes on the 31st. Markets currently believe that the Fed will keep the Fed funds rate at 5.25. The 97.4% probability of that. It means nobody is betting that the Fed is going to cut rates at this meeting. Now, as we get to the March meeting, though, this is currently 51% probability that we're going to be down to 5%. So markets are basically saying that, hey, we think the Fed is going to cut rates by 0.25%. They're going to go from 5.25 to 5%. And they only go in quarter point increments. And there's a tiny, tiny fraction that say, hey, we think we're even going to see more than that. But you can tell not many people at all. However, this is kind of what's important is that the last couple of days, this was actually 75%. So the market probability is dropping. That means that that market traders are starting to kind of pull back on that idea that the Fed is going to need to start cutting rates in March. And as we see that happen now, that actually drives our mortgage rates to get a little bit worse. And that's where we get into these fancy charts and what we call the candlestick charts here, where we look at how the mortgage-backed securities are selling. Mortgage rates are actually based on the pricing and the trading of mortgage-backed securities. It's not a bunch of folks sitting around a table that decide where to set your mortgage rates that day. It's actually based on how much profit they can make selling your mortgage on the back end. Not who collects your check, the servicer, as we call that, but securitized, meaning you've got countries and insurance funds and hedge funds that invest in mortgages. And that's how come we always have enough money to lend and enough money to keep buying houses with. So looking at this pattern, we're kind of seeing some negatives here. And that's why we've seen mortgage rates that have gone up the last couple of days and hopefully doesn't go up too much further than this. But if we start to see this number go higher, the idea that the Fed is going to keep rates the same heading towards March, you'll actually see mortgage rates react to that now. It doesn't wait until it happens. They actually start reacting now. You'll also see like that 10-year treasury yield go higher. Those of you that may follow the 10-year treasury, mortgage rates are not based on that 10-year treasury, but they do trade in lockstep. So if you see the 10-year treasury yield moving higher, generally mortgage rates are getting worse. If you see that 10-year treasury yield move lower, generally mortgage rates have room to get better. And again, one doesn't have causality and effect. It doesn't mean that just because this will happen that rates will go down, but they do tend to move in lockstep. So there's some stuff for y'all for this week. Brandi, we're getting long in the tooth. Yeah, I was gonna say, is there anything you would want to leave everybody with this week?
No, I think one of the things that stood out to me is when you say that rates actually go higher, it's really important for the clients to know that rates maybe they didn't necessarily go higher for them. It could be something that the lender didn't actually price into the rates that day. So when they go higher, it's kind of relative, and you really just need to reach out to your lender about your qualifications because maybe they didn't change for you.
Right. That's definitely a good note. And also, when we talk about rates getting worse, I use the term worse or getting higher. It means that your interest rate itself may not have changed, but the amount of money that you were getting as a credit or the amount of money it would cost you to get that rate might have changed. And we call that rebate pricing, and oftentimes. So if you were getting, let's say, 6.25, and you were going to get $1,000 back from the lender towards your closing costs, well, maybe today you could still get 6.25, but maybe it's going to cost you $200. And that's normal. That's not your lender. You know, they didn't lose at a poker game. That is just the reality of what has changed in the markets, and it's an ever-changing environment. So, let's see. I'm looking for lots of people commenting, which is good. Dunlop, Tasha, it may not have had a great timing. I love it. I really would love to see what happened again. Excited to get the forwards at this point, like you mentioned. And then here you go. Let me know when they drop. So, yep, we'll keep you all posted. Thank you, Brandi, for joining us. Appreciate having you. Remember, everybody, you can join us next week. Same bat time, same bat channel, 10 a.m., 12 p.m. Eastern, 11 a.m. Central, 10 a.m. Mountain, 9 a.m. Pacific. So we'll see you then. Take care, everybody.